There's a tiny AI contractor nobody's talking about that just made a $250 million bet on the future of military intelligence. While everyone's obsessed with Nvidia and Palantir, this sub-$10 stock is quietly embedding itself into the Pentagon's most critical operations. But here's the twist. It's bleeding cash, just lost 20% of its revenue, and Wall Street can't decide if it's a genius play or a spectacular train wreck waiting to happen. Because what BigBear.ai is building isn't just another AI tool. It's the decision support software that could determine how the US military responds to threats in real time. And they're doing it with a fraction of the resources their competitors have. Let me walk you through what's really happening here. BigBear.ai started as two government analytics firms that merged in 2021 and went public through a SPAC deal. Think ex-military analysts and engineers who spent years in the defense data trenches, then decided to build their own AI-powered platform. Their headquarters is in Columbia, Maryland, basically in the backyard of every major federal agency you can think of, and their CEO, Kevin McAleenan, the former acting secretary of Homeland Security. That's not just credibility. That's a Rolodex. Here's what they actually do. BigBear sells AI analytics software and services primarily to the US government. We're talking tools that help military commanders predict battlefield scenarios, systems that use facial recognition to screen travelers at airports, platforms that optimize supply chains for manufacturers. They've got software called Observe, Orient, and Predict, basically turning massive datasets into actionable intelligence in real time. The Navy's using their tech in maritime exercises. Customs agencies are deploying it at major airports. The Army relies on it for logistics planning. Pretty wild, right? A company most people have never heard of is powering critical national security operations. Now here's where it gets interesting. The stock has been on an absolute roller coaster. We're talking up over 300% in the past year. It was a sub-$2 penny stock 12 months ago, rocketed above $10 on AI hype, and now trades around $7. That's the tug of war you're seeing. Speculative enthusiasm versus fundamental concerns. Because when you look under the hood, the numbers tell a complicated story. Revenue is actually declining. Third quarter 2025 came in at $33 million, down 20% year over year. They're guiding for full year revenue of $125 to $140 million, which represents a 10 to 20% drop from the prior year. In an era when AI companies are supposed to be growing like crazy, BigBear's top line is contracting. Management blames lower orders in certain Army programs. Basically, legacy contracts are finishing faster than new revenue is ramping up. And profitability? Nowhere in sight. They posted a net loss of $396 million over the last 12 months. That's losing nearly $3 for every dollar of revenue they bring in. Operating losses are deep, expenses are rising faster than sales, and cash burn is running about $10 million per quarter. But here's the silver lining, and it's a big one. BigBear now has $456 million in cash. That's a record high, built through massive equity and convertible note financings in 2025. They raised $300 million by issuing new shares, which means, yes, significant dilution for existing shareholders, but it also means they have more cash on hand than their anticipated 3-year revenues. Think about that. This company has bought itself a serious runway to fund operations and acquisitions. The question isn't whether they'll run out of money tomorrow. The question is whether they'll invest that cash wisely or burn through it unproductively. And that brings us to the bombshell announcement that just sent the stock jumping 20% in a single day. November 10th, 2025, BigBear reports Q3 earnings and announces they're acquiring Ask Sage for $250 million. Ask Sage is a generative AI platform focused on defense and secure deployments. Think ChatGPT level technology, but built specifically for military use. The deal is priced at $250 million for a company expected to have $25 million in annual recurring revenue next year. That's rapid growth, a 6x jump from 2024. This is BigBear's bet to bolster their software offerings with what they're calling agentic AI capabilities. The market loved it. Shares spiked over 20% the next trading day. Investors saw this as BigBear moving from offense to offense, not just defending their existing business, but aggressively expanding into cutting-edge AI technology. But there's another twist. During the earnings call, McAleenan mentioned that some contracts have been delayed due to the temporary government shutdown, but he expects accelerated spending on border security and defense once Congress passes major funding legislation. You see where this is going? BigBear is betting that the political winds are shifting in their favor. More government spending on AI, more contracts up for grabs, more opportunities to deploy their tech, and they've been proving their value. In late September, they participated in Unitas 2025, a major multinational naval exercise deploying AI solutions for maritime intelligence. The Navy's selection sent the stock on a 9-day rally. Investors recognize this as validation that Big Bear's tech actually works at scale. They've partnered with companies to deliver AI-enabled edge computing for battlefields. They're showcasing platforms that orchestrate AI and sensors in real naval drills. These aren't just press releases, they're demonstrations that the Pentagon sees Big Bear is more than just another contractor. That's the part most people miss. While Palantir gets all the headlines and trades at a $40 billion market cap, Big Bear is the scrappy underdog securing its own wins. They're positioning themselves as Palantir for the rest of us, nimble, pure-play AI with deep government ties. But let's talk about the elephant in the room. The valuation makes no sense if you're looking purely at today's numbers. Big Bear has a $3.2 billion market cap. That's about 22 times trailing sales for a company with declining revenue and massive losses. For context, even Palantir trades around 15 times sales. You're paying a premium for something that hasn't materialized yet. Traditional metrics like price to earnings don't even apply here because earnings are deeply negative. The bet you're making is that revenue growth will sharply reverse, margins will dramatically improve, and Big Bear will transform from a cash-burning contractor into a high-margin software company. Wall Street analysts are split. The consensus rating recently shifted from buy to hold. Average price targets sit around $6, which is actually below the current trading price. Some analysts see potential with targets as high as $8. Others warn the stock is ahead of fundamentals and should trade in the mid-single digits. And here's something you need to know. Insiders have been selling, not buying. The CFO sold shares around $4 to $5. A board member sold at $5.83, and a major shareholder from a prior acquisition liquidated nearly 27 million shares at under $3. That's a yellow flag. The people closest to the company have been treating rallies as opportunities to cash out, not double down. Now, people sell stock for lots of reasons: diversification, tax planning, personal liquidity. But the one-sided nature of these transactions suggests they might not see the same upside that retail traders are pricing in. The stock's also heavily shorted, about 18% of the float. That means sophisticated investors are betting against it, which creates this weird dynamic where the stock can squeeze higher on good news, but also face constant selling pressure. From a technical standpoint, Big Bear is range-bound. It's rallied hard multiple times in 2025, only to get knocked back down around the $10 level, which happens to be the original SPAC listing price. That's become a major resistance zone. Every time it approaches, sellers come out in force. Support has emerged around $5.50 to $6. If bad news hits, analysts think it could test the mid-$4. A break above $10 would be very bullish technically, but it would likely require some game-changing fundamental news. A massive contract win, a buyout rumor, something that shifts the entire narrative. Right now, the chart's telling a story of volatility and hesitation. Traders are bullish on the concept, but quick to take profits because the underlying concerns remain. So what are the real risks here? Let me break them down plainly. First, cash burn and dilution. Big Bear raised hundreds of millions by issuing new shares. The share count exploded from 130 million at IPO to 435 million. Future funding needs or acquisitions could lead to even more dilution, which hurts existing shareholders. Second, they haven't proven they can make money. Gross margins around 27% are mediocre for a software company. If they can't scale the high-margin software side of the business, they could bleed cash for years. Third, competitive pressure is intense. Palantir is aggressively marketing AI platforms to the military with a massive head start. Traditional defense giants like Booz Allen and CACI have long-standing relationships and deep resources. Tech behemoths like Microsoft and Amazon are pushing into this space. Big Bear has to fight for every contract, often as a subcontractor or niche provider. And fourth, customer concentration. Big Bear's revenue heavily depends on a few government customers. If any major program gets cut, delayed, or recompeted, revenue can drop suddenly. We already saw that in 2025 with the Army program slowdown. And fifth, execution risk on the AskSage acquisition. They're paying $250 million, nearly 2 years of their own revenue, for a company that needs to deliver $25 million in ARR next year. If integration fails or the tech doesn't mesh, they'll have burned a quarter of their cash for nothing. Here's the bottom line. BigBear.ai is a high-risk, high-reward play. This isn't a safe investment, it's a moonshot that could either land among the stars or explode on the launch pad. The bull case is compelling. If they land major contracts, if AskSage performs as expected, if government AI spending accelerates, if they successfully transition from a services contractor to a high-margin software company, then today's $7 stock price could look cheap a year from now. The bear case is equally strong. If revenue keeps declining, if losses continue mounting, if they burn through that cash pile without meaningful returns, if Palantir and the big players squeeze them out, then the current valuation makes no sense and the stock could fall significantly. Wall Street's essentially saying, show me. The potential is there, the government relationships are real, the technology seems to work, but the execution risks are massive and the financial performance hasn't justified the hype yet. My take? This is a hold if you already own it from lower levels and have high risk tolerance. But if you're thinking about buying now after a 300% run, you're paying a premium for hoped for future growth that isn't guaranteed.